Yeah, typically, what type of borrowers do you think fixing their rates would suit? Is it more we've talked about people who are quite adverse to risk. Would it be also maybe first home buyers where it's their first big debt that they've ever encountered in their entire life? And
I don't think it's borrower type. I think it's where we are in the market, right? Regardless of who the borrower is. Like if it's a first home buyer and they're taking on this debt, they don't want to be fixing the rate on a higher rate and then they miss out if rates drop and then they keep paying that high repayment. That wouldn't be a great first experience.
Yeah.
Regardless of the borrower, it's like where we're at in the market, how's the market looking? I've had someone ask I actually want to fix it. Rates go up by 0.25, they go up by 0.5, we'll still be Welcome to the Brokers Lounge, and here we are again, your two favorites, Eddie and Carlo, and
at least one favourite.
Well, at least
That's you talking about.
that's you.
Too kind.
It's good to be back, and looking forward to another year of smashing it. Right?
Yes. Looking forward to it.
Yeah, absolutely.
Going to be a big one, that's for sure.
Every year is always,
and I'm sure there'll be lots of different curveballs thrown at us throughout the year.
That's it.
A curveball, otherwise known as the RBA. I'm sure they're about to throw the first curveball coming up. So
yeah,
we'll
started to talk about potential rate hikes coming up. So we'll monitor that and we'll bring any updates as they come. I can use Anchor now. Yep. First episode, we're going to be discussing fixed versus variable. And the reason for that is there has been a lot of clients asking if they should fix or not. And there has been certain changes in rates over the last few months, really since late last year all through to this year, where fixed rates have been changing. They've dropped, then they went back up. And does it make sense? And we've been trying to answer these questions with clients. So we thought, let's put it into an episode and put it out there. So yeah, we'll discuss fixed versus variable, and is it relevant, and is it something to consider? Decision around structuring and focusing around structuring is usually more relevant rather than focusing on what is the cheapest interest rate. And always it comes down to your personal circumstances and what you're trying to achieve. And yeah, how to mitigate a bit of risk. So yeah, let's jump into it.
Sure. Sounds good.
Cool. So with variable rates haven't changed much in the last 6 months or so, probably. Yeah. We're still seeing lowest interest rates, variable rates around the 5.25, 5.3, and investment rates around the 5.5%. That's obviously for principal and interest repayments. Yep. While on the other side, we're seeing cheapest fixed rates, and that's usually over 2 years minimum. We're looking around the 5.2 to 5.3% fixing over 2 years. So when someone comes and asks us, is it wise or is it the right thing to do to fix our rates? I usually ask them, why do you want to fix it? Right?
Yeah,
and usually the answer is, rates might go up again, right? And it's totally, understandable, because if rates go back up and you've fixed your rates, then you're probably gonna keep your repayments within a certain limit.
Yep.
And you might benefit in the long term. But obviously, we don't know how rates going to act over the next couple of years, especially if you're fixing over 2 years. It's a relatively long term, right? Yeah. So as of now, the difference between fixed and variable is not huge. So for you to go and fix your full loan amount on a 5.2 compared to a 5.3 variable rate, really are not benefiting much.
Yeah, unless you got the crystal ball. Yeah, you know what's coming.
Exactly. And if you had the crystal ball, you wouldn't have a mortgage anyway.
And let us know.
Yeah. So yeah, that's why rate is only part of the decision, and it's focusing more around understanding what effect would it have if rates go up by 0.5% over the next year. Would it affect you really badly? Would it impact your cash flow? Would it I don't know, compromise your repayments. So we have to answer all these questions, and that's where we need to understand and see if it makes sense to fix.
Yep.
Right?
100%. Yep. So, and I think, off the back of that, it is a very common question that we do get around, is it now a good time to fix rates? But, one thing we've learned, well, I've definitely learned over the years that you never beat the banks. The banks will always price their rates well and truly ahead of what the market actually ends up doing. So it's always around your personal circumstance.
Unless you fixed your rates in 2021.
Yeah,
You would have beaten the bank for a year, then
correct.
they sucked your blood over the last 40 years.
Well, our job is really to understand the emotions that sit behind those type of questions as well, because there's always an underlying emotion or thought process that goes when people are asking us those questions. It's normally because, one, they're a little bit stressed about what could potentially happen. Like you said, is it going to put them under financial stress? Hopefully it shouldn't, because typically when we're doing serviceability, there's always that buffer that we build into it. But unfortunately, people can get loans and then extend themselves with other loans or expenses, whatever it might be. So I think it's important to probably understand when fixing actually does make sense. And I think the biggest one is always around requiring some certainty around your repayments, making sure that whatever the repayments are, it's not going to be any issue to your cash flow. So those who want a more predictable cash flow, and or it's quite tight as well. So if they've got a very tight cash flow, there's not a lot of room to move. Fixed rates can obviously work in your favour, because 25 basis point rise by the RBA can have a fairly big impact. $600,000-$700,000 loans, another $150 a month just in interest alone.
Yep.
So for a lot of people, that can hurt. Living expenses are probably still rising. For me, I feel like they're still rising. I don't feel like they're under control. That's for sure. Utilities seem to keep rising, and we were just talking about before about the insurance premiums as well. They keep rising. So, any slight interest rate rise can have a big impact. And then if you roll in another 1, 2, possibly 3 rate rises, touch wood, that doesn't happen. It can have a big impact. So, another reason for fixing loans where it can actually make sense, if you've got no plans to actually make any changes, so you're not planning on selling, refinancing, restructuring your loans, whatever, you just want a nice set and forget, here's a loan, not going to do anything for the next 5 years, let's fix for 2 or 3 years to give me that certainty. And, I'm not going to have to worry about if I need to change my circumstances, I'm going to be hit with a break cost or whatever it might be. So, and obviously for those clients who are very risk adverse, and you can normally pick it when you speak to clients how worried they are about where the repayments are.
Yeah.
It makes sense to start talking about fixing. On the flip side, when fixing doesn't make sense, it's pretty much the reverse of everything I've just said, isn't it? But I'll go through them very quickly. So obviously, if it changes, if you're expecting your circumstances to change in the near future, be it changing a property or whatever, or maybe looking to restructure loans, potentially may get, some people might know they're going to be getting some lump sums coming up, inheritance or whatever it might be, and they want to pay it off their loan. So probably not a great time to be fixing if that was the case. The flexibility. And I think if people are fixing purely to beat the market, that's a big no-no in my eyes. I don't know if it is in your eyes, but I'm sure it would be. But
There's gamblers out there.
they're a gambler. Look, that's
And sometimes it works. Like,
I know in America, when they've got longer term, they can fix loans for 30 years. They can actually work in their favour.
But I think that could be a thing here, really. Like, because realistically, if you're getting into the property market and you're taking out that debt, it's good to know that these are going to be my repayments for the full term.
Yeah.
Right? It's not like I need to keep budgeting depending on what the inflation is doing and what the Reserve Bank is doing and what China's doing. And it's like, dude, I just want to pay my mortgage. I don't give a shit about what's happening in the world.
Yeah.
And it keeps coming up and down, and it just messes your budgeting, it messes your plans, really, right? Like a lot of people struggled over the last few years with much higher interest rates than what rates were before. So, maybe it's something we should consider.
Yeah.
But I totally agree. I guess fixing really is it can be both. Like that's what I'm going to talk about now. You can split really, like, and have
The best of both worlds.
Yeah,
Yep.
both wills. And I guess that's where it helps to understand how that works. And splitting is basically, you can choose to fix a certain portion and then leave another split as a variable, where that variable you can have the offset accounting, you can choose to make as much extra repayments as you want. And that was really my recommendation for most people who were fixing back in 21 and 22 when rates were really low on fixed rates. And the strategy was just like fix 90% of your mortgage, obviously depending on what the loan amount is, but just have the cheapest rate on the biggest parts of the mortgage, and then just take a small chunk over 2 years or 3 years, whatever the term was, and have that as variable, where just aim to pay that down in the next 2 years, 3 years, do as much extra repayments as you can. And then once your fixed rate expires, we can look at what the rates are and what the next phase is going to be. But yeah, splitting will give you the option to use the offset, do extra repayments if you need to, and then have that certainty on a certain amount where, it's not going to affect if rates go up. You still have a bit of certainty there. Basically splitting is a very, very popular option.
Yeah, and I think that's one of the common questions that we do get as well is when clients do decide they're going to split their loans and go part fixed, part variable, one of the common questions that I used to cop a lot was, so what percentage should I actually fix? Should it be 50-50, 60-40, 75-20, but whatever it might be? It's one of the common questions that we always get. So, but once again, it always comes down to the client's personal circumstances. If they're expecting larger bonuses or inheritance, whatever it might be, you need to be mindful of that before you fix too much of it. Because like you said, the aim is to, whatever you leave variable, that's the bit you want to smash as hard as you possibly can over that fixed rate period, because there's no cost for actually repaying that portion of the loan, the variable rate portion of the loan, any earlier. So
that's basically it.
Yeah.
And obviously there's things that people need to be aware about if they're fixing.
Yep. Break cost is obviously the big one, because it can be expensive. People say, why should I pay a cost of repaying my loan earlier when it's fixed? And essentially, when you're fixing your loan, you're entering into a contract with the bank that says the bank's guaranteeing that they will keep that rate for a certain period of time. Now, if the market moves, the bank could be out of money. Not that they ever lose money. We know that. We know how you feel about that, Eddie. So, but essentially that will mean that, if you repay it and you go to, or you switch it to a variable rate loan, you're typically going to be doing that when variable rates are lower than the fixed rates, which means you're benefiting from that. So there's going to be a cost. Bear in mind too, with break costs on fixed rate loans, the banks typically do allow you to pay over and above your normal repayments during that fixed rate period. It's typically limited to about $10,000 a year.
Yeah. Different banks have different policies.
Yeah, but just as a rule of thumb, you can pay typically a little bit more than your normal repayments. But anything over and above that, you can be hit with costs as well. So just one thing to bear in mind, and that what those costs are. It's $1 million. I don't know. Have you ever seen the formula that the banks use for break costs? I saw it many years ago, and it's the longest formula I've ever seen in my entire. It's like Einstein developed a.
It's basically how many days left on your fixed term.
Yeah.
By what the loan amount is, by what the interest rate is, and they
times by how many tools are in the City Chrome's tool set. Sorry, that's the old part.
But it's worth mentioning that they don't charge you a break cost.
Yeah.
If you get out of a fixed term when variable rates are higher.
Yeah.
It's funny, right?
Yeah. And the other thing to keep in mind as well, that, most fixed rate loans don't have offset accounts as well. So just something else to bear in mind, especially if you're wanting to fix the entire part of your loan. So, if you're splitting it, okay, no problems. Have the offset the offset account against the variable rate component, and you win on both sides. So yeah, that's probably the main things to keep in mind when it comes to fixed rate loans in terms of costs, offsets, redraws, stuff like that. So
yeah. But bottom line is really like, if you want to fix your loan, it's basically you're trying to mitigate risk in a certain way. It's just, okay, these are going to be my repayments every single month for the next 1, 2, 3, 4, or 5 years. and I don't need to worry about it. You know, I'm going to budget for that amount to come out of my account every single month. Rates go up, rates go down. I don't care. I'm pretty sure you'll care if rates go down, but that's the risk you run of when you're fixing your term for a long period of time on slightly higher end of the rates, right? Like, I think we're still on the higher end of rates. If rates were probably around the mid fours, I think that would be like a good
point to feel that's where we were heading only up until a couple of months ago.
Yeah, and that goes back to the inflation rates, like how they've gone up this month. And when you say expenses are going up, I get that's what's fueling up the inflation and keeping inflation high, because everything's expensive. It's not like people are overspending. It's just,
it's also quite seasonal as well. Like, inflation data is now released on a monthly basis rather than on a quarterly basis. But we've just come out of the Christmas New Year period. So typically what happens leading up to Christmas and the New Year period, people are spending a hell of a lot more. So yeah, it'd be interesting if the RBA does pull the trigger and decide to hike rates, because, you know, is it too soon to be doing that? But, you know, we've had a couple of months where inflation has ticked up, which is not what they want to see.
Exactly.
Maybe they'll do it as a bit of a scare tactic. Who knows? So let's see. Eddie, typically, what type of borrowers do you think fixing their rates would suit? Is it more we've talked about people who are quite adverse to risk. Would it be also maybe first home buyers where, you know, it's their first big debt that they've ever encountered in their entire life? And
I don't think it's borrower type. I think it's where we are in the market, right? Like, regardless of who the borrower is, like if it's a first home buyer and they're taking on this debt, they don't want to be fixing the rate on a higher rate, and then they miss out if rates drop, and then they keep paying that high repayment. That wouldn't be a great first experience. So regardless of the borrower, in my opinion, regardless of the borrower, it's like where we're at in the market, how's the market looking, and what do they want, right? Like I've had someone ask, like, I actually want to fix it. Okay, if rates go up by 0.25, if they go up by 0.5, we'll still be, you know, better off, right? At least for a year. And then if they start going down, it's not going to drop massively under what we're at the moment. And that's all speculations, obviously. But that's their line of thinking. And then you're like, if you're comfortable with that, then by all means, I'm here to help you. But I haven't been hugely advocating for fixing rates. Go back 3 months, 4 months back, fixing rates made more sense because it had like a 4.8.
Yeah, the differential between fixed and variable was a lot bigger, wasn't it?
Yeah, it was massively different.
Like, you could almost say to the clients, okay, if you fix it at X rate, current variable rate is this, it would require 3, possibly 4 rate cuts
to match
what you're getting on the fixed rate. Now we're literally almost, I think the rates you talked about before, they're almost line ball. So, you know, if rates do tick up, the question will be, you know, if you fix now and rates do tick up, how much before, you know, how many times does the variable rate need to go up before?
Until you're worse off.
Exactly right. Exactly right. Yeah.
But that's the dilemma is when fixed rates were 4.8%, the sentiment was rates are dropping.
Yeah.
And
that's why most people
4.8 is not great, right? Because rates going to be in mid fours variables. And obviously people who fixed are winning now, and people who didn't fix missed the boat because, like you said, banks are always ahead and they're always pricing how it's going to be.
So who's running the RBA, Eddie? Come on.
Who's running the RBA? The big banks behind this conspiracy theory. I think it's aliens behind.
Sometimes I do wonder, actually.
Very good. So bottom line, there's no right answer. Sorry.
That's true.
It's so easy to say, oh, you go this way or go that way, but you could go both ways. Like we said, you can split apart, you could go fully variable, you could go fully fixed. It really comes down to what you want to achieve, what your risk appetite is like, what your extra repayment's going to be, how much money you're going to have in your offset account. Like, there's so many questions to ask to be able to identify which way to go. So it's not like one answer fits all, which is, I guess, in everything.
Yeah. Very cool. Look, I think it's probably a good thing to talk about some of the common myths that we hear out there in the market with regards to fixed rate loans. I think the first one is fixing doesn't always guarantee savings. Can sometimes be the exact opposite. That fixed rate loans can be changed, but that obviously does come at a cost as well. It's important to understand that. The lowest rate does not always equal the best loan. Structure is absolutely paramount. Interest rate is only I won't say a small part, it's still a big part of it, but it's just one piece of the puzzle.
Yeah.
Getting the structure right, getting, if you're looking at that fixed variable rate split as well, getting that structured in the best possible way to suit your own individual circumstances. There is not a one size fits all when it comes to this. And the other common myth is there is no perfect rate out there. You're always probably going to get to a point where you've made a decision and then 6 months later you go, I knew I should have done the other way, but whatever it might be. But I think the main thing is just structure your loans to suit your own personal circumstances. And in the long run, it'll always pay off for you. So
that's it. There you go.
All right.
Well, I guess to recap, basically, right structure matters more than rate.
Yep.
Obviously, like Carlo said, the rate is very important, but there's other considerations to take into account. Fixed or variable or split, it all can work. Depends on what you want and how you want it. Always ask professionals and someone to help you tailor your to your situation and needs, right? And obviously, this is always general information.
Yeah.
Just run your personal details with someone that will help you, and you should be able to get the right answer and get guidance in terms of how to do it, what to do, and hopefully, hopefully rates start to cool down. That's only hopeful thinking, wishful thinking, which means nothing, but why not? Why not? And hopefully just to get a bit of break, really. It's been hard few last years for many people. And
I think that the past few months has probably been a good indication how things can quickly change.
Yeah.
I think if we went back to one of our podcasts early last year or even the year before, and where we were talking about where rates were, the conversation has just all of a sudden dramatically changed in the past couple of months purely because of those inflation data.
Yeah.
And it's usually because, even my son, he goes, "Oh, Dad, did you hear the inflation rate is such and such now? I guess that means rates are going up." And I'm going, so
there you go.
It really is. People are taking a lot more notice as to this inflation data.
Yeah.
They know it does drive the RBA cash rate quite heavily nowadays. So
yeah.
I think the big thing that I've learned is that there's a lot of people out there who rely on what their friends or family would tell them as what's the best way to go with their loans. But once again, that's very general. That could work well with your friends, but it may not necessarily work with you. So
100%.
What Eddie said with regards to seeking that personal advice, that's massive because you can get it very horribly wrong and it could cost you thousands.
Yeah.
And we're not just talking,
and
we've seen $200, it could be thousands of dollars. So
I've seen it many times, So by all means, reach out. Any questions, anything we can help with, we're always available 24/7, 7 days a week. Carlo does Saturday, Sundays. I do Monday.
So I only do Saturdays and Sundays, not Monday to Friday.
Part-time, miserable playful.
But Eddie does the 1 a.m. calls, so feel free to do my call.
I do, so I've done that. No, thanks again. And look forward to a year ahead full of good information, hopefully valuable information. And see you then.
All right. Take care, everyone.
See ya.
Bye-bye.
Bye.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Head to the show notes if you want to book a free call to discuss your personal situation.